Who really benefits when your money loses value? Inflation is often spoken about in hushed tones, as if it were an invisible tax on everyday life. For most people, its impact is immediate and personal. The price of groceries rises, rent creeps upward, and the dollars in your savings account buy less than they did yesterday. It feels like an erosion of financial security, a slow bleed that chips away at purchasing power. But while inflation may seem like a universal burden, it doesn't affect everyone equally. Behind the scenes, certain groups and institutions can actually benefit when the money you hold loses value. Understanding who gains and why reveals a hidden side of economics that shapes financial policy, investment strategies, and even global trade. At its core, inflation is more than a shift in prices. It's a redistribution of wealth. Some players in the economy leverage rising prices to reduce debt burdens, improve export competitiveness, or even strengthen governmental finances. Others, however, see their earnings and savings diminish in ways they cannot easily control. By examining the mechanisms that allow inflation to favor some while hurting many, we can begin to see the economic game being played and why certain policies persist despite their visible downsides for ordinary people. Let's dive into the key beneficiaries of money losing value. Governments and debt relief. One of the most significant, yet often overlooked, beneficiaries of inflation is the government. Governments typically carry enormous debt, ranging from domestic obligations like infrastructure bonds to international loans. When money loses value through inflation, the real burden of this debt diminishes. For example, a government that owes $1 trillion today may find that in 5 years, thanks to inflation, the same amount of debt represents far less purchasing power than it did at the time it was issued. Essentially, inflation allows governments to repay debts with cheaper dollars, reducing fiscal strain without having to raise taxes or make deep spending cuts. This phenomenon is especially appealing in periods of high public spending. When governments face deficits due to economic crises, social programs, or military expenditures, inflation becomes a tool to manage obligations in a less painful way than directly cutting budgets. Politicians may even tolerate moderate inflation for this reason, as it acts as an invisible tax on the population while easing debt repayment. Citizens end up losing purchasing power, but governments can preserve or even expand their operational capacity without triggering the immediate backlash that tax hikes often provoke. Another angle where governments benefit is through debt monetization. Central banks can purchase government bonds, effectively turning public debt into newly created money. As the money supply increases and inflation accelerates, the real value of the debt shrinks. While this tactic can be risky if overused, potentially leading to runaway inflation, it is a method many governments historically rely on to manage national debt. It's a subtle advantage. Ordinary people see their savings erode, while the government's obligations quietly become more manageable. Furthermore, inflation can sometimes stimulate nominal economic growth, boosting government revenue through higher tax receipts even if real incomes are stagnant. As prices rise, businesses and workers report higher nominal income, leading to increased tax collections. Governments can then maintain or expand public services without needing to raise rates or cut programs, creating an indirect benefit from the reduced purchasing power experienced by the general population. This complex interplay makes inflation a powerful, if double-edged, tool in governmental financial strategy. Borrowers with fixed-rate loans. Individuals or entities with fixed-rate loans are another group that can benefit when money loses value. A fixed-rate loan locks in the interest rate for the life of the loan, meaning that regardless of what happens in the economy, the borrower pays the same nominal amount each period. During inflationary periods, the real value of those payments declines. In other words, borrowers repay their debts with dollars that are worth less than when they originally borrowed them. This can represent substantial savings over time, effectively reducing the cost of borrowing. For example, consider a homeowner with a 30-year fixed mortgage. If inflation rises significantly, the fixed monthly payment remains constant in nominal terms, but in real terms, the financial burden diminishes. The house itself may increase in nominal value, while the debt remains fixed, creating a situation where the borrower gains equity faster and enjoys increased purchasing power relative to their debt obligations. Savvy borrowers often understand this dynamic and may even favor fixed-rate debt during periods where moderate inflation is expected. Businesses can benefit similarly. A company that has secured long-term fixed-rate financing for capital investments may see its repayment obligations effectively reduced by inflation. This can improve cash flow, make existing projects more profitable, and provide a competitive edge over companies that rely on short-term or variable rate debt. Over time, the difference between nominal and real payments can add up to significant financial advantages, effectively turning inflation into an unplanned but welcome financial strategy for borrowers. However, it's important to note that this benefit only applies if the loan's interest rate is truly fixed and inflation is higher than anticipated. Borrowers with variable rate loans or credit cards often experience the opposite effect, where interest rates rise alongside inflation, negating these advantages. The asymmetry underscores why understanding the mechanics of money losing value is crucial for financial planning. Exporters and competitiveness abroad. Another group that can benefit from inflation is exporters, particularly in countries where domestic inflation is higher than that of trade partners. Inflation often leads to a depreciation of the local currency relative to foreign currencies. While this reduces purchasing power at home, it makes goods and services priced in the local currency cheaper on the international market. Foreign buyers can purchase more with their stronger currency, boosting exports and potentially increasing profits for domestic manufacturers and service providers. This dynamic can enhance a country's trade balance. Export-driven businesses experience a surge in demand as overseas buyers take advantage of favorable exchange rates, and national industries that rely heavily on international markets can grow rapidly even amid domestic inflationary pressures. In essence, while citizens face rising prices, exporters gain a competitive edge globally, sometimes transforming inflation from a domestic problem into an international advantage. Furthermore, sustained inflation can encourage long-term investments in export-oriented sectors. Companies may expand production, innovate products, or enter new markets to capitalize on the currency advantage. Governments may also support these businesses with subsidies or policies designed to amplify export competitiveness. The result is a redistribution of benefits. While ordinary consumers pay higher prices domestically, exporters can thrive and even contribute to national economic growth. This interplay highlights the complex and often contradictory nature of inflation. While it erodes domestic purchasing power, it can simultaneously improve the international position of domestic producers. The dual effects, pain for local consumers, gain for businesses selling abroad, demonstrate why policymakers often tolerate or even encourage moderate inflation in export-driven economies. Asset holders, real estate, stocks, commodities. People or entities that hold tangible or appreciating assets like real estate, stocks, or commodities often benefit significantly when money loses value. Inflation erodes the purchasing power of cash, but physical assets or equities tend to maintain or even increase in nominal value over time. For example, real estate prices typically rise with inflation, meaning property owners see their wealth grow even if their cash savings lose value. A home purchased years ago for a fixed price may be worth far more today, not because the property itself improved dramatically, but because each unit of currency has lost value. Similarly, commodities like gold, oil, or agricultural products often serve as hedges against inflation. Investors holding these assets find that rising prices in the broader economy tend to increase the nominal value of their holdings. Stocks can also benefit indirectly. Companies often adjust their product prices upward during inflationary periods, which can lead to higher revenues and ultimately higher stock prices. The effect is that asset holders gain in wealth without actively taking on more risk, while those relying solely on cash or fixed income see the real value of their holdings diminish. The advantage is not only financial, but psychological. Asset owners perceive inflation as less threatening because their net worth is tied to items whose value moves with or ahead of price increases. This creates a divergence in economic experiences. While wage earners and savers feel the pinch of rising costs, asset holders may experience real gains. In some cases, this dynamic contributes to wealth inequality, as those already able to invest in tangible or appreciating assets grow wealthier while those without access to such investments struggle to maintain purchasing power. Additionally, inflation can spur further investment into assets as people seek to protect themselves from devalued cash. This creates a reinforcing cycle. Higher demand drives asset prices up, further benefiting those who already hold them. It's one reason why real estate and stock markets often perform well in moderate inflationary environments, even when broader consumer purchasing power is declining. Banks and financial institutions. Banks and financial institutions occupy a unique position in an inflationary economy. On one hand, they are creditors, and inflation can erode the real value of loan repayments. On the other hand, Banks often have mechanisms to protect themselves, and in some cases, they can profit directly from rising prices. For instance, banks that issue loans with interest rates that adjust over time or are higher than inflation can maintain or even increase profits while borrowers repay in devalued dollars. The structure of lending often ensures that financial institutions remain insulated from moderate inflationary pressures. Moreover, banks profit from inflation indirectly through transaction fees, trading activities, and asset management. Rising asset prices increase the nominal value of loans, mortgages, and investments, boosting the bank's balance sheet. Inflation also often leads to higher interest rates, which can increase the spread between what banks earn on loans versus what they pay on deposits. In essence, banks are positioned to benefit from both the rising nominal value of assets and the income derived from lending, particularly when they have sophisticated risk management systems. Financial institutions also gain when inflation encourages investment in securities, commodities, and other assets. As clients move cash into stocks, bonds, or precious metals to hedge against devaluation, banks earn fees and commissions, further capitalizing on the economic conditions that hurt ordinary savers. Large banks and investment firms may even influence monetary policy and market expectations, giving them strategic advantages in navigating periods of money losing value. Additionally, banks often act as intermediaries for inflation-linked products like Treasury inflation-protected securities or inflation-indexed bonds. By facilitating access to these financial instruments, banks earn revenue while providing a buffer for investors, positioning themselves as essential players in an inflationary economy. The net effect is that, unlike average cash holders, banks often emerge not just unscathed, but advantaged when money loses value. Corporations with pricing power. Corporations that can dictate prices for their goods or services, those with significant market share, brand loyalty, or unique offerings, are another major beneficiary of inflation. When prices rise, these companies can pass on increased costs to consumers without losing significant sales volume. Unlike businesses operating in highly competitive, price-sensitive markets, corporations with pricing power maintain profit margins even as inflation erodes the value of money. In effect, inflation becomes a tool to grow revenue rather than a threat to the bottom line. For example, luxury brands, technology companies with proprietary products, and essential service providers often adjust their pricing to reflect rising costs without diminishing demand. Consumers, unable to find substitutes, end up paying more while the company enjoys higher nominal profits. This advantage is amplified during periods of persistent inflation, as ongoing price adjustments allow the corporation to maintain or even expand margins while competitors with less pricing flexibility struggle. Pricing power also enables long-term strategic benefits. Corporations can invest in new projects, acquisitions, or R&D using revenues that keep pace with inflation, strengthening market dominance. Meanwhile, fixed cost expenses like long-term leases, labor contracts, or debt repayments become easier to manage in real terms as the nominal revenues rise alongside inflation. This creates a double advantage, increasing profitability while stabilizing financial obligations. In some cases, corporations with pricing power can even influence consumer expectations and market trends. By consistently adjusting prices in line with inflation, they normalize higher costs and maintain brand perception, reinforcing their ability to thrive while smaller competitors face the squeeze of rising input costs. Ultimately, this makes inflation a strategic asset for dominant companies, highlighting the uneven distribution of benefits when money loses value. Those who hedge or speculate. Individuals and institutions with the ability to hedge against inflation or speculate on market movements are among the clear beneficiaries when money loses value. Hedging strategies might include investing in inflation-protected securities, derivatives, or foreign currencies, while speculative activity could involve shorting assets likely to decline in real value or leveraging commodities and equities expected to rise with inflation. Those with access to sophisticated financial tools can turn rising prices into profits rather than losses. For instance, traders and hedge funds often thrive in volatile, inflationary environments because they can exploit discrepancies between nominal and real asset values. By anticipating shifts in interest rates, commodity prices, or currency valuations, they position themselves to gain as ordinary savers experience eroding purchasing power. Unlike the general public, who may be limited to cash or fixed income accounts, these players actively navigate inflationary conditions to create opportunities, turning uncertainty into advantage. Even small-scale investors who understand hedging principles can benefit, though institutional investors have a far larger reach. The key is preparation. Those who predict or respond strategically to inflation can preserve wealth or even expand it, while those without access to such instruments face a slow, unavoidable decline in purchasing power. This dynamic underscores the unequal landscape of inflation. It's not just about money losing value, it's about who knows how to act before it does. The cost to savers and fixed income earners. While many groups gain from inflation, those who rely on savings or fixed incomes often bear the brunt of its effects. People holding cash, traditional savings accounts, or low-interest fixed income investments like bonds see the real value of their money decline as prices rise. A dollar saved today buys less tomorrow, and even conservative savers can find their financial security eroded over time. This demographic is particularly vulnerable because their wealth isn't tied to appreciating assets or adjustable financial instruments. Fixed income earners, such as retirees living on pensions or annuities, experience a similar challenge. Their incomes remain static in nominal terms, meaning that rising prices gradually reduce their standard of living. What once covered groceries, utilities, and healthcare may no longer suffice as inflation erodes purchasing power. The effect is compounded when inflation outpaces any cost of living adjustments tied to their income, forcing individuals to either cut back on spending or draw down principal savings faster than planned. The disparity between beneficiaries and those at a disadvantage highlights the social and economic implications of inflation. While governments, borrowers, and asset holders gain, the most financially vulnerable see diminishing resources, creating a form of hidden wealth redistribution. It's a stark reminder that the cost of money losing value is rarely evenly shared, often placing the heaviest burden on those least equipped to defend against it. Investors in precious silver. Precious metals like gold and silver have long been viewed as safe havens against inflation, and for good reason. Unlike cash, these assets maintain intrinsic value and often appreciate when fiat currency declines. Investors who hold metals during periods of rising prices effectively preserve purchasing power, shielding wealth from the erosive effects of inflation. Gold, in particular, is seen as a universal hedge due to its historical stability and liquidity, making it highly attractive to both individual and institutional investors. The mechanics are straightforward. As inflation accelerates, the nominal value of currency declines, but the market value of precious metals tends to rise. This creates a direct gain for those holding these assets, contrasting sharply with savers or fixed income earners whose holdings lose real value. Silver and other industrially useful metals also benefit from rising prices as supply-demand dynamics amplify the inflationary impact on their market value. Beyond protection, precious metals can serve as strategic investments and portfolio diversification. By including gold or silver, investors reduce exposure to cash devaluation and potentially profit from market volatility linked to inflation. The result is a powerful asymmetry. While everyday money loses value, metals investors gain security and, often, financial advantage, reinforcing the notion that inflation creates winners and losers in sharply uneven ways. Governments funding social programs more easily. Inflation can indirectly help governments fund social programs with less immediate political backlash. As prices rise, the real value of existing government debt diminishes, reducing the fiscal burden. At the same time, nominal revenues often increase as wages and corporate profits rise, boosting tax receipts without raising tax rates. This combination allows governments to maintain or expand social spending programs such as healthcare, education, or welfare, while technically keeping the budget balanced. From a strategic perspective, this hidden benefit of inflation provides governments with more flexibility. Politicians can fund initiatives without imposing overt tax increases, which may be unpopular with voters. The cost is largely borne by ordinary citizens whose purchasing power is eroded, creating a subtle transfer of resources from the population to public programs. Inflation essentially acts as a silent tool for governments to support social objectives while managing fiscal obligations in ways that are less visible than direct taxation. Moreover, when social programs are financed in an inflationary environment, the relative impact of fixed monetary allocations is lessened. The government can expand services in nominal terms, even if real terms are relatively flat, creating the perception of active governance and responsiveness. In this way, inflation can become a tactical advantage for governments aiming to maintain political goodwill while addressing social needs. Speculators in currency and inflation-linked assets. Speculators who actively engage in currency markets or inflation-linked financial products often stand to benefit the most when money loses value. Inflation can create volatility in exchange rates, bond yields, and commodity prices, which traders exploit for profit. Investors can hedge against declines or bet on movements in real interest rates, often earning returns that outpace inflation itself. Currency speculation, in particular, allows investors to capitalize on disparities between countries experiencing different inflation rates. For example, if one nation's currency is losing value faster than another's, traders can buy the stronger currency and sell the weaker one for profit. Similarly, inflation-linked assets like Treasury inflation-protected securities or inflation swaps provide mechanisms for earning returns that adjust with rising prices, directly turning inflation into a financial advantage. These strategies are often inaccessible to average savers, highlighting again how certain market participants profit while the general public faces losses. Sophisticated investors treat inflation not as a risk but as an opportunity, leveraging it to enhance returns and preserve wealth in ways ordinary earners cannot. Companies with large debt becomes easier to service. Corporations carrying significant debt can benefit in an inflationary environment, particularly if their liabilities are fixed rate. As inflation erodes the real value of money, the actual burden of debt repayment decreases in real terms. A company that owes billions of dollars today may find that in a few years, thanks to inflation, the same repayment amounts represent a smaller fraction of revenue generated by rising prices. This effect is amplified for businesses whose revenues rise with inflation. If costs increase but prices rise proportionally, or if the company has pricing power, the nominal profits increase while fixed debts remain constant. In practical terms, inflation acts like an unplanned financial lever, reducing leverage ratios and improving balance sheets without requiring operational changes or additional capital. The advantage can be so significant that some corporations may even welcome moderate inflation, particularly in capital-intensive industries where debt financing is essential. By reducing the real cost of borrowing, inflation allows companies to redirect resources toward investment, expansion, or dividends, turning a macroeconomic challenge into a strategic opportunity. Individuals with inflation-indexed income or benefits. Certain individuals receive income or benefits that automatically adjust with inflation, insulating them from the erosion of purchasing power. Examples include recipients of inflation-indexed pensions, Social Security benefits, or salary arrangements with cost-of-living adjustments. These individuals essentially enjoy a built-in hedge against rising prices, maintaining their standard of living even as ordinary savers and wage earners struggle. This automatic adjustment allows recipients to plan and spend with confidence, knowing that the value of their income will keep pace with inflation. In contrast, those without such protections experience a decline in real earnings, highlighting a stark economic divide. Inflation-indexed income transforms what could be a period of financial stress into one of stability, underscoring the asymmetry in how inflation affects different groups. As we've seen, when money loses value, the impacts aren't evenly distributed. Governments can fund programs more easily, speculators and asset holders can profit, and corporations with debt or pricing power may even thrive. Meanwhile, savers and those with fixed incomes often bear the cost. Understanding who really benefits and who loses helps us make smarter financial decisions and navigate an economy that is constantly in flux. If you found this breakdown eye-opening, make sure to like this video, subscribe to our channel, and drop a comment below telling us which group surprised you the most. Your engagement helps us create more content that breaks down complex financial topics in a way anyone can understand.